All right, Warner Brothers Discovery reporting fourth quarter results. The adjusted EBITDA grew by 11% over the prior year to $2.7 billion. It was driven by growth in direct-to-consumer and studio segments. Revenue of $10 billion was below estimates of $10.2 billion. Global direct-to-consumer subscribers up by 5.8% to 116.9 million over the third quarter. Max added 19 million subscribers in 2024, and the company says it expects to deliver about $1.3 billion in adjusted EBITDA this year. That stock right now up by about 8 cents. For more on this, we want to bring in Tom Rogers, ClearGrid executive chairman, also a former NBC cable president and a CNBC contributor. And Tom, what do you think about the numbers as you're seeing them so far?
Well, Becky, great to be here. I think it's a tale of two brothers, actually, Warner Brothers. You got what looks like a meaningful growth trajectory on the streaming side, talking about getting to 150 million global subs by the end of next year, surpassing a billion in EBITDA for 2025. With sub numbers of 150 million, you're getting into Disney Plus territory and maybe beyond. On the other hand, the cable business is not doing well. It is declining, as all the industry trends are. These numbers are probably somewhat worse than people expected. But the key, I think, on the cable side here is they stabilized things. They got their deal done with Charter. They got their deal done with Comcast early. Looks like with the deals they have in place, they have about 80% of their cable renewals solidified, which is very different than what a lot of people expected here. When they lost the NBA, there was a lot of expectation that there might be mass dropping of the Warner cable services. And at least as industry trends are not going in the right direction, they seem to have stabilized things on that front.
What about the ad revenue? I saw that number down 11%. Is there a reason, an explanation for that? Does that cause concern?
Well, you got a cable situation that's just pretty ugly. Cable subscribers were down by 9%. The cable side of the advertising equation was down about 16% off of audience declines of about 28%. If you believe the slope is going to continue to worsen like that, that's a tough situation. On the other hand, they have something going with Disney and Hulu and the Max bundle, which looks like it is giving them some domestic strength on the streaming side. And the fact that those deals were done in part by being able to bundle Max with the cable bundle is going to give them some streaming stability with cable subscribers. So you really have to look at this as a company with two major pieces. They've separated the two divisions, and the streaming side of the equation is getting some real scale. The cable side continues to have trouble, but still contributing enough cash flow for the company to continue to delever. And of course, as it delevers on the overall, with down about $20 billion in debt from when this started, the equity side of the equation should increase in value.
What's the future hold just in terms of what to do with those businesses, what combinations might come forward? I mean, that's what everybody's trying to figure out, right? Who teams up with who? How do you split and change these businesses with all the other cable businesses that are going through the same thing?
Well, the company clearly has a lot of optionality. I mean, you could see with the separating of the cable assets from the streaming assets, that the reorganization they did, you could see them do NBC spin type situation where the cable networks are spun off into a separate public company. You could see potentially the kind of deal that DirecTV did with a private equity firm on those cable assets. You could see some kind of joint venture with either Paramount Plus or Peacock on the streaming side. Those are very difficult to negotiate because of all kinds of issues of what kind of flexibility that gives your company when your key growth asset is tied up with another company, but that's certainly a possibility. You could possibly see the sale of the streaming and studio side to another company. I think the point here is that they have some time. They have their debt locked up for over 13 years at under 5% interest rates, so they're not facing any time bomb there. Having stabilized the cable side, they're not under any immediate pressure there. They do have HBO, which still has a lot of sizzle to it with White Lotus and Hacks and other major program franchises coming back, so they have a good lineup. The issue is whether or not they can buck industry trends somewhat on the cable side, which continues to deteriorate, and that looks like a tough order, but they seem to be performing better than people expected on the streaming side.